Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. Please note that the views shared here are not personalized financial advice and are for informational purposes only. Always consult with a financial professional before making any investment decisions. Now, let's dive in.
You know, today wasn't just a weekday. I think it was a day where the market sort of shed an illusion.
An illusion of stability.
Exactly. For months, those major indexes have looked, on the surface, incredibly stable. But today, that stability finally broke down. It was a moment of some pretty profound technical significance.
And the numbers definitely bear that out. We saw broad weakness. Right across the board. The S&P 500 fell almost a full percent.
Down 0.92% to close at 6,672.41.
Right. And the Dow dropped 1.18%. That's 557 points. The tech-heavy NASDAQ composite, it was down 0.84%.
Which puts it firmly in correction territory. It's now down more than 5% from its recent peaks.
But, those numbers, as big as they don't really tell the whole story. The real story is where the S&P 500 landed.
Exactly. We've been watching this level for a while, and today, the dam finally broke. We're talking about the S&P 500 breaking below its 50-day moving average.
Which is a huge technical benchmark.
Huge. And it's one that's very closely watched, especially by algorithmic trading systems.
Okay, so for listeners who might not be tracking charting every single day, what does that 50-day moving average really represent? And why is this particular breach so dramatic?
Well, think of the 50-day moving average as the market's recent average price floor. It's a line of consistent support. When the market trades above it, it signifies upward momentum and health.
Okay.
What makes this breach so dramatic is just how long that strength lasted. The S&P had been above this line for 138 trading sessions straight.
138 days, wow.
It was the second longest streak of its kind this entire century.
So after 138 days of holding, it just gives way. But, haven't we seen this before? The market's been so resilient, pullbacks get bought up so quickly. Why should we trust this signal this time? Is this just a transient wobble?
That is the critical question. And the reason traders are paying such close attention is because breaking a support level that has held for this long tends to trigger a cascade effect.
Okay.
It often signals that the underlying weakness that has been brewing is finally taking hold. When that line breaks, it automatically triggers algorithmic selling.
The machines just start selling.
The machines just start selling. They're designed to reverse momentum when long-term support is lost. We often see a minor pullback risk morph into a much deeper correction when this happens. It suggests there's some profound weakness right beneath those seemingly stable index levels we've been talking about.
And we can connect that technical breakdown directly to the underlying market health, can't we? Because if you look beneath the mega-cap tech stocks, things have been shaky for a while.
Oh, absolutely. The technical breakdown just confirms what we've been seeing in market breadth.
Which measures how many stocks are actually participating in the rally.
Right. And the market internals are deteriorating. The clearest evidence is looking at the S&P 500 equal weight index.
Okay, hold on. For clarity, what's the difference between the standard S&P 500 and the equal weight version?
So the standard S&P is cap-weighted. That means a massive company like Apple or Nvidia has a much, much greater influence on the index's movement than a smaller company.
Got it.
The equal weight index strips that out. It treats all 500 companies exactly the same. So when the cap-weighted index is doing much better than the equal-weighted one, it tells you the rally is really narrow.
It's just being driven by a handful of giants.
Precisely. And that's what that equal-weight index is telling us now. It's shouting that the strength was highly concentrated.
So what's the data point there?
The equal-weight index is having its best month relative to the cap-weighted index since March. This confirms that this narrow leadership in mega-cap tech has been masking much broader market weakness for months.
So the technical break today really validates that hidden fragility.
It does, which is leading to extreme caution, especially because investors are bracing for two major high-stakes events this week.
These binary events, as we call them, because they could tip the scales dramatically in either direction.
Exactly. The market is positioned very cautiously ahead of two massive catalysts. First, you've got Nvidia's earnings report on Wednesday after the close.
And second, the long-delayed September jobs report coming out Thursday.
Yeah.
Let's start with Nvidia. That company is no longer just a chip maker. It's a proxy for the entire AI investment thesis.
That's right. It's the bellwether. Nvidia shares were already down 1.3% today as traders hedge their bets. And if you look at the options market,
where the pros bet on future volatility.
right, the options pricing suggests a dramatic 7.38% move in either direction after earnings.
7.38%, that seems high.
It is high. That expected move is nearly double the stock's recent average post-earnings volatility. So this just underscores how much event risk is tied up in one company right now. If Nvidia disappoints on guidance, the whole sector could reprice.
And then, looking at bigger picture, it really feels like the market has totally lost conviction on the Federal Reserve's next step. That feeds right into the caution, doesn't it?
Oh, absolutely.
A few weeks ago, it felt like the market knew what the Fed was doing. Now, we're back to a complete toss-up.
It is genuinely the great Fed coin flip. A month ago, the odds of the Fed cutting rates in December were over 90%.
Over 90%.
That probability has now absolutely plummeted. It's sitting at approximately 43 to 50%. It's a true coin toss, and that uncertainty is just paralyzing traders.
What caused that massive, sudden shift in expectation?
Well, there are three main culprits. First, you have persistent 3% inflation. The Fed's target is 2%, and we've been above it for 4 years now.
4 years.
Second, the rhetoric from Fed officials has turned increasingly hawkish. Atlanta Fed President Bostic recently warned that price stability remains the more pressing risk. That signals they are not done fighting inflation.
And the third factor has to be that data vacuum we've been talking about, created by the government shutdown.
Absolutely. The 43-day government shutdown caused an unprecedented data vacuum, so policymakers have been flying blind. And if you look at Fed funds futures, which is how sophisticated investors bet on where rates will be, they now imply very limited easing.
So not a lot of cuts coming.
Not at all. They see rates ending the year around 3.775%, only just a little lower than the current 3.87%. The lack of data is leading the market to price in more caution from the Fed.
Let's pivot back to technology for a second, because the sector gave us one of the biggest divergences today. Tech broadly led the market down.
It's now collectively down 5% in November.
But one massive name just flew high. This shows the market isn't just selling indiscriminately, right? It's being extremely discerning.
It is. Overall, the skepticism about AI valuation is definitely mounting. The question is, when does all this massive investment in infrastructure, which boosts companies like Nvidia, translate into meaningful returns for the companies using that infrastructure?
The AI valuation reckoning.
Yeah, that's it. And it caused tech to be the worst performing sector today. We even had that notable revelation that SoftBank sold $5.83 billion in Nvidia shares recently. When large informed holders start exiting, it puts a chill on the high flyers.
But then you have the complete counter-narrative played out by Alphabet. They surged more than 4% today to record highs. Why the sudden love for Alphabet amid all this tech pullback?
That surge was triggered by the disclosure that Berkshire Hathaway, Warren Buffett's firm, took a massive stake.
How massive?
$4.93 billion worth. That's 17.85 million shares.
That's a huge vote of confidence, especially coming from a legendary value investor like Buffett.
It's a very important signal. While the broader market is questioning these sky-high AI valuations, this move suggests that value investors are seeing opportunities in select tech names with more established business models and, well, what they see as more reasonable valuations.
So it's the difference between betting on the company selling the shovels in the gold rush versus betting on the strongest operator actually using those shovels.
That's a great way to put it.
Okay, that frames the discussion beautifully. Let's move out of the equity world and look at the cross-asset landscape. How did fixed income react to all this uncertainty?
Fixed income showed modest strength, which reflects that caution. The 10-year Treasury yield declined 1 basis point to 4.14%.
And let's just define basis points quickly.
A basis point is just 1/100%, so a tiny drop. But the bigger story is the shape of the yield curve. We track the 2S10's yield curve slope.
So the difference between short-term rates and long-term rates. What is that telling us right now?
It's telling us a fascinating story. The 2S10's curve is now positively sloped at plus 54 basis points.
Okay.
Now, when this curve is inverted, when short-term rates are higher than long-term, it often signals acute recession concerns. The fact that it's positive now suggests markets are moving past those fears.
Good.
But the slope isn't steep enough to price in aggressive easing from the Fed. It's consistent with that coin toss scenario we just talked about.
And what about the credit markets, the risk of corporate default?
They remain surprisingly tight. Credit spreads are at 120 basis points for investment grade and 302 for high-yield debt. This means the cushion against any deterioration is minimal.
Let's turn to crypto. which is certainly feeling some institutional stress right now.
Mm.
Bitcoin is trading near that $93,466 to $95,000 range.
Yeah.
That sounds like a level with some high stakes.
It absolutely is, because falling below that range threatens to wipe out all of the gains Bitcoin saw throughout 2025.
It would drop it below the year-end close from 2024.
Exactly. And the data supporting this is concerning. Long-term holders sold an estimated 815,000 BTC over the past 30 days. That's the largest exodus we've seen since early 2024.
Is this just pure crypto market fear, or is there a macro force at play here connecting back to the rest of the financial system?
Market watcher Mel Madison provided some crucial context for this. They pointed out that the government shutdown created one of the driest periods for fiscal liquidity in months.
Okay, that's a concept that needs unpacking. How does a government shutdown create a liquidity drought, and how does that affect a volatile asset like crypto?
Well, fiscal liquidity refers to the flow of cash the government injects into the system through spending and other programs. When the government shuts down, those flows just stop or slow dramatically.
Creating a temporary vacuum of cash.
Right. And when liquidity dries up, traders tend to pull capital from the most volatile, highest-risk assets first. That includes crypto. However, Madison anticipates that once the delays are sorted out, the floodgates are about to open as those fiscal flows return.
Suggesting this particular crypto stress might be transient and tied directly to the macro environment.
That's the idea.
Which leads us perfectly into our final segment, the impending data deluge. The market has been starving for information, and now it's about to be force-fed weeks of critical economic data all at once.
It's the information void meets the data fire hose. We're going to get a massive backlog of delayed reports within days. But what makes this situation truly unprecedented is that the White House confirmed October data remains permanently impaired.
Permanently impaired. That sounds serious for policymaking.
It is. It means policymakers at the Fed are operating with a huge information gap. They can't fully trust the data they're receiving. It makes defining their path for the December meeting extremely challenging.
So, given everything, the technical breakdown, the Nvidia risk, this flood of data, what are the key questions you, the listener, need to be asking this week?
I think it comes down to 3 critical issues that will ultimately shape expectations for any kind of end-of-year rally.
Okay, what's number 1?
First is the Nvidia validation. Can their guidance on Wednesday validate the massive AI investment thesis, or will that skepticism we talked about win out?
And number 2 has to be the jobs report.
The labor market truth. Will Thursday's delayed data confirm the deterioration that private indicators have suggested, or will the official numbers shock everyone with resilience?
And third, the consumer health check.
Right. What will earnings from Home Depot, Target, and Walmart reveal about consumer health heading into the make-or-break holiday season?
It all comes down to a really binary setup, doesn't it? This week will either resolve the massive uncertainty that's been brewing, or it's going to intensify it.
Exactly. The current base case, the most likely scenario, has about a 45% probability right now, and that scenario is choppy consolidation.
Meaning the S&P 500 just grinds sideways.
Pretty much. Ranges between 6,500 and 6,750, with volatility persisting until the data clears up and we get a firm direction. This one is less about direction and more about finally defining the risks that have been hidden for months.
That's all for today's episode of the Daily Consolidation. If you enjoyed our analysis, remember to like this video and subscribe to our channel for more daily market briefings. See you at the next close.